All right, hey, welcome back, folks. So today we're talking about the end of the awesome times that are the 1920s. We've talked about and you've read about how the 20s were completely taken by storm with the consumer economy, where people were really buying everything that they could buy on credit. Um, Today we're going to talk about why that sort of, with a couple other things, brings the whole economy to a screeching halt right at the very end of 1929, sort of kicking off the really not so happy decade of the 1930s like the 20s were. All right, so today we're going to talk about how the Great Depression starts with the collapse of the stock market. To review, so the 1920s, again, very, very good economic times. Everybody was buying things on credit and paying for them later. And what that means is people owe money to the banks. Keep that in mind. People owe money to the banks, but they're planning on paying it back over time, right? That's how it works with a credit card. You pay it back with interest over time. So by the end of the 1920s, Wall Street and the people in charge of buying stocks, which if you're not super familiar, which I don't know why you would be, but if you're not super familiar with how the stock market works, in a nutshell, public people invest money into companies by buying a stock or a share of that company. Meaning, like if you wanted a share of Apple or Google or Amazon today, you could buy one share of Apple, or you could buy one share of Google, or you could buy however many shares you want. So at this time in the 1920s, the public, people started investing their money into companies because they believe that in doing so, those companies will continue to be profitable, and the value of that little piece that they bought, the value of that stock, they're hoping it will go up and it will make them a profit over time. Now, that doesn't always work that way. Sometimes the company will not do as well and it will not be profitable, and the share price will actually go down, which you don't want. But what people are hoping for at the time is that things are going up. And remind yourselves, guys, the 1920s, the economy's going so well, you'd be a fool to not be investing your money in the stock market because everybody's spending all their money and companies are doing great. All right, so you've probably seen some pictures like these in movies where you've got people trading on the New York Stock Exchange, people trading stocks down on the floor there. This is the same way that they're doing it in the 1920s. However, in the 1920s, there was a difference in how you could buy a stock. Basically, you only had to put 10% of the stock's value down, which, again, guys, I'm not your math teacher. I'm actually terrible at math. But let's just say for fun that you wanted one share of a stock and that stock in a company was worth $100 a share. So what you would do is you'd go to your stockbroker and you'd say, hey, I want one $100 share of whatever company. And they'd say, great, all you have to pay is $10. And we will hook you up with the other 90. So the broker or the person that is doing the investing for you would come up with the other 90%. And what people would do, and I'm not going to get into all the crazy math of how it works, but what it would do is if that stock price went up, that $10 that you invested would also go up. And then when the stock maybe increased to from being $100 in value, maybe let's say it went up to 150, then if you wanted to, you could pull your money out, you could sell your stock, and now you'd have $15 or 10% of that 150. So you would have made $5 in that scenario. Now, in the 1920s, people were doing this very, very often, and they were doing it really, really quickly. They were buying a stock, letting it make money, and then selling it off, which is great for you, but it is not very good for the company because to the company, they think that they have this investment money coming in, but they don't because you keep selling your stocks really, really quickly. So it gives these companies sort of a false sense of security and confidence in that market. Okay, and don't get too caught up in that right now, but just know that people are buying stocks and selling them quickly to make a quick profit during the 1920s while the economy is doing so good. But you can see here right at the end of 1929, particularly the end of September into October, you can start to see that it starts to plummet. Okay, so by late October of 1929, these stocks that people are buying, everything starts to change. Okay, October 29th, more specifically, of 1929, people, for whatever reason, somebody starts this trend where people on October 29th start to sell all of their stocks because they get this sense of fear that the stock market is going to go down. And lo and behold, in one day, okay, in 2 days, in a 48-hour period, the U.S. economy loses $30 billion. People sell almost 16.5 million stocks are sold in about a day. And you're sitting there thinking, okay, Mr. Bryant, who cares? People sold their stocks. Why is this important? Well, keep this in mind. When people go and they sell their stocks, what they do is they run to the bank to go get their money. Okay? This is a picture of people storming the New York Stock Exchange. Okay? Storming Wall Street. So what's happening is people have sold their stocks and now they want their money. And they're so afraid of the economy and what's about to happen that they run to the bank. Okay? So that Tuesday, October 29th of 1929, the stock market crashes. It goes into this crazy whirlwind downfall. This day is known as Black Tuesday. So what ends up happening, and you can see a picture of it here, people will run to the bank because everybody tries to withdraw their money. Now, this is a much longer conversation that, to be honest, you might get a better conversation out of somebody who teaches business or economics. But if everybody tries to go and get their money from the bank at the very same time, the bank doesn't have all of that money. Even today, guys, the bank doesn't hold all of your money in like a little folder with your name on it. That's not how it works. They take the money that you deposit. Let's say that you have a checking account with $500 in it. The bank is going to take that $500 and they're going to invest it in all of the other customers that they have, and that money is going to circulate around. So if people try and go in and take all of their money all at one time, the bank will just straight up run out of money, which is exactly what happens in 1929. So many banks, about 9,000 banks, go out of business almost immediately because people run to try and get their money because the stock market looks like it's about to tank, which it does. And the banks just straight up don't have that money. Can you imagine that? Can you imagine running to the bank and saying, hey, I'd like to take out the $1,000 that I put in, and the bank says, sorry, we just don't have your money. And there's no insurance on the money either. The bank just straight up lost your money, which is why maybe you have a grandparent or a great-grandparent who still does not trust banks. I don't know if any of you have like a grandfather who like keeps his money in his mattress, which a lot of people from this generation, as they got older, they never put their money back in banks after this situation because they never trusted them ever again. This is exactly why, because the banks lost everybody's money. And you can see over time, 1929 being the first year where it really starts to jump, people and banks, banks just start closing in crazy high numbers, just astronomically high numbers. And all of a sudden, what this is going to mean for the end of the 1920s and into the 30s is that people are going to get laid off. There's not going to be any jobs. At the height of this thing, about 1 in every 4 people don't have a job. Okay? So people lose their savings and people go bankrupt. All right? The height of the Depression is about 1932. So almost 1 in 4 of Americans, one in 4 Americans are out of work. So unemployment rate is crazy high at the time, which is kind of interesting if you look at the situation that we're in right now with the coronavirus and what it's doing to the global economy. We haven't had unemployment rate, an unemployment rate that was that high in several years up until literally right now. The last time I put this PowerPoint, I updated the situation. The unemployment rate was 4.1% in 2017. All right, right now, it's about 15 or 16%, which is the highest it's been in a very, very, very long time. So what happens is they don't have money. People can't afford to buy products. So if everybody's out there buying new vacuum cleaners or washing machines or whatever products, if nobody has any money to go buy those products, that company, let's say it's Frigidaire selling refrigerators, Frigidaire doesn't make any money because nobody can come buy their refrigerators. So because they don't make any money, they have to take all the people that are employed by Frigidaire and let them go. They can't afford to pay them, so they lay off those workers. And now those workers that don't have jobs, they don't have any money, so they can't spend their money at the restaurant down the street or the movie theater down the street or at the grocery store. So you can kind of see this crazy cycle of the money's gone, nobody can spend their money, companies then don't make any money, and it becomes this crazy, vicious cycle of nobody has any work, nobody has any money. And people go absolutely ballistic. Guys, I mean, people actually take their own lives once they realize what's happening. Several people at the height of the Great Depression will realize that all of their savings are gone. They don't have any money. They appear to not have any hope. And a lot of people take their own lives. Homelessness becomes a huge issue in the late 1920s, really into the early 1930s. And guys, this depression is going to last about 12 to 13, arguably 14 or 15 years. Okay? And this is just a diagram explaining what we talked about a couple minutes ago. If you have unemployment, people can't produce anything. And if people can't produce anything, nobody can buy anything, which then, of course, returns us back to unemployment. And it just becomes this terrible cycle. Now, if you are anybody who's, I would consider to be a normal, regular, everyday American person, you would do what a lot of people are doing and what they're doing right now. A lot of people are looking to the government and saying, hey, government, can you help us out? The president during the Great Depression is a guy whose name is Herbert Hoover. Ironically enough, Herbert Hoover was a big businessman prior to being president. Now, because of his own personal political beliefs, he did not think that the Great Depression was going to amount to a really big problem. I mean, for some context, we've had economic problems before, but none of them have ever really been on this scale. So the president goes, it's probably going to blow over. It's probably not going to be a huge deal. Yet, he doesn't do anything, yet this problem continues to rise and rise and rise. So Herbert Hoover becomes intensely, intensely unpopular at this time. I mean, just nobody could even fathom voting for him again because Herbert Hoover just doesn't do anything to help out. I mean, you can see the massive lines. These were called bread lines, people standing in line at like a soup kitchen to go get a meal because nobody can afford to eat. I mean, just massive unemployment, massive economic problems throughout the United States. Just becomes a huge issue. Anybody doing whatever they can to make ends meet. Now, this really hurts a lot of people. And homelessness rises. People live in these little scrapyard shanty towns. I mean, this is literally like scrap wood and trash and scrap metal out here outside of cities because people can't afford to pay rent. So these homeless little towns that eventually people nickname Hoovervilles start popping up all over the place. And you just begin to see this intense shift in the American sense of morale. You see this intense shift in what the economy's doing. Nobody has any sort of hope of moving forward. So that's your quick jump into the Great Depression. I'm going to post an assignment or two to kind of reinforce what we talked about here today. But your biggest takeaway from the Depression here is that we go from, in the 1920s, having this intensely successful economy, one that's doing great, everybody's spending their money, businesses are doing awesome. We go from that, we just sort of plummet. We just sort of free fall into this massive depression that's going to last over a decade. And it really starts to shift how Americans think of the government and how Americans think of the economy at large. As always, guys, I hope that everybody's staying safe. Hope that everybody's doing well. If you have any questions or want to talk about this topic or any of these topics anymore, please don't hesitate to reach out if you have any questions. Many of you are, and I really, really appreciate that. So with that, I'm going to leave you. And until next time, guys, take it easy.